Okay, so the first step that I do when I'm researching a stock is I put that stock into my Yahoo Finance watch list. And I just want to talk for a second about what it is to own an individual stock. So if you own an individual stock, like a ticker, like Apple or Amazon, for example, you are giving that company some of your money in the hopes that that stock goes up, right? So if you are giving a company your money, you need to watch that company and figure out what they're doing, to the good or to the bad, so that you can decide if you want to have more money with this company or less money with this company. But overall, if you are investing in an individual company, you need to make it your job to watch what that company is doing. If you don't have the time to read about the stocks that you are in, individual stock investing may not be for you. You really have to spend some time to evaluate that. If that's the best thing for you, because there's a lot of ETFs out there that could be better opportunities where you wouldn't have to watch them as much. But stocks have movements that are associated with things that happen in the market, things that happen in the sector or industry that stock is in, and they also just react to news that stock is bringing out, good news or bad news, based on sales or a new product, etc. So how do I monitor stocks? I monitor them on Yahoo Finance. So Yahoo Finance does a couple things for me. The first thing is that on their first header, when you log into the page, it gives you the market news of the day, which is really important if you are an individual stock investor, to understand what interest rates do, what unemployment numbers do to the stock market overall, right? Because good news makes the stocks go up and bad news makes them come down. Some of this information is transitory and you may not care. That's fair enough. I mean, a lot of news I do not care about. The ups and downs daily that happen in the stock market, the volatility is very normal part of being an investor. But if there is bad news upon bad news upon bad news in the market overall, that may be a hint that perhaps it's time to pull some of our money out of the market. The news that came out in 2022 with the war and interest rates and stuff like that was a really good example of bad news upon bad news just bringing the market overall down. So Yahoo Finance gives you an overall picture of where we are at in the market every day. And you might want to check in on that, if not every day, once a week, once a month, etc. if you are holding stocks individually and want to get that information. Okay, so whenever I log into my account and my account goes up in value really dramatically, or it comes down in value dramatically, and I mean, I'll define dramatic, I don't know, like a 2%, 3% pullback or something like that, or a 3% gain, I immediately click over to Yahoo Finance if it's in the middle of the day and say, what happened? What news came out? And usually there will be a really good explanation on Yahoo Finance as to what happened. So I love seeing that for my financial education and seeing how stocks interact with news, like world events, mini black swan events, big black swan events, unemployment numbers, inflation numbers, etc. So the other thing that Yahoo Finance is so valuable for, and I would say the main thing, is as soon as you become interested in a stock, or it's a stock that you own, you plug that into your stock watch list. When you put something in your stock watch list on Yahoo Finance, it has this beautiful algorithm that brings you all the news about that individual stock and the sector or industry that stock is in. So if you are reading 10 minutes a day, and that should be your homework as a stock investor, reading Yahoo Finance 10 minutes a day about the stocks that you are invested in, there will become this waterfall effect of your knowledge over the years. So you will become a mini expert in that stock. And that's really what you want, is to become an expert in all the stocks that you're invested in. Because then when something goes to the upside or the downside in that stock, you'll know immediately, and you can decide whether you want to become more invested or less invested in that stock.